So as we start, just to be clear, I have no special powers. I have no special insights into anything that's going on in Washington, D.C. regarding tariffs, and I certainly have no special powers when it comes to predicting the markets other than some of the tools that I've learned to use over the years. And when we look at the S&P and we just kind of look at it on a technical basis, because right now, if we were just to assume there was nothing else going on in the world and we were just clearly looking at the price, that may help us give us at least a sense of where things may be going from here. So I think it's fairly obvious to say that the market had gotten to pretty oversold levels, based on an RSI, based on being below the lower Bollinger Band. If we had taken this bear flag and extended it lower, we basically hit the objective that was on last Monday. So at least from those perspectives, you can make an argument and make a very strong case for stocks to rally from here. I don't really think that there needs to be any news for that to happen. In fact, you began to notice that even on Friday, the market just seemed to want to go up. We were seeing the VIX coming down. And so, again, if we just were to look at the VIX, you would say ordinarily VIX 37 probably pretty high. Could it go higher? Yes, it's going to be news dependent. But if we start thinking about where the S&P has been trading the last couple of days, you have a 6% decline, a 1.5% decline, another 1.5% decline, a 10% increase, a 3.5% decline, and about a 2% gain. So, it's not to say that the VIX at around 36 is fairly valued. You could make an argument from that. But again, there's also a good chance that you get a volatility crush coming. And if you were to see the VIX, let's say, move back down to 23 or even move to the upper end of this range around 28 or 30, that could certainly also be a reason for stocks to rise. So I think the ingredients have been there that you could potentially see a rally in the market. I don't think there needed to be news over the weekend for that to happen. That said, when we kind of look at the broader and we kind of take a little bit of a deeper look, we remove the Bollinger Bands, we can clearly see that one spot that we might look to on the upside certainly comes at around 54.50. These types of gaps tend to get filled fairly quickly. It's not unusual to see that happen. That would be up about 2% from where we are. And then, of course, there's this gap up here that also hasn't been filled at around 56.70. So I don't think anyone should be ruling out the potential here for a 4 to 5% upside move in the S&P 500 over the next couple of days. The thing that we really don't know, and we're not going to know until we get a little bit more color and clarity when markets reopen on Monday, is what's going to happen with all those capital flows that we've been really talking about now for some time. This was the high back here in February. Please remember to subscribe to this channel, like this video, share it with your friends. I'm trying to continue to grow the channel out in 2025, and I need your help to do that. And if we look at the Japanese yen, that's been sending us warning messages now for a little bit of time, and we've been using that pretty successfully to help us understand, where this market is ultimately going. When we look at the yen, it's been sort of in this mode of really moving lower over the last couple of months, and generally it's hard to really find a fundamental reason for that to change. Again, when we look at the yen from a technical perspective, one again could argue that maybe the yen is getting a little bit oversold here. Maybe it's due for a little bit of a bounce. You can certainly make a case that there is support around the 141.80 region, and that would also be supportive of potentially a yen moving higher, maybe coming all the way back to and testing the 146.70 area maybe later this week. You can also make the same case really for the Swiss franc, which is also quote unquote oversold. And again, one could also make an argument for a rebound back to around 84 cents on the dollar. And when we look at 10-year rates, those have also moved pretty violently over the last couple of days. Again, one could make an argument for a move back to around the 435 region. So when you look at FX, when you look at rates, when you look at stocks, they're all due for some sort of technical rebound here. But I think more importantly is where are we going to be over the next few months? And that becomes a much harder picture to begin to discern. I think one thing is clear. is that when we look at the fundamentals of the market, it seems clear that the BOJ is probably still in some form of a rate hiking cycle. They haven't ruled that out. It seems more likely than not that we're going to continue to see money flow back to, and this yen carry trade continue to unwind, and continue to see the yen strengthening and potentially move back below this 140 level in the coming weeks, because of, again, rates in Japan basically at 30-year highs now on the 10-year. It's pretty hard to, you can really begin to make a case for why, rates in Japan could be heading higher, especially if there is going to be continued rate rises and rate increases there as they run around the 4% inflation rate. And it also sounds to some degree as if the ECB may be getting closer to the bottom when it comes to rate cuts as well. Really, we should go and identify when the euro's big move started, and it started really around the beginning of March. That was when Germany announced that big spending plan that they had planned to do, and we saw the German 10-year really explode. And this is really what I think set a lot of things in motion. In fact, here it is right here on March 5th when we saw the German 10-year rise by nearly 30 basis points. Now, it's come back in because we've seen rates in the U.S. and Germany kind of separate as capital has left the U.S. and returned to Germany, or capital has left and returned to France or Italy or any of those countries. But in general, European rates rose sharply following the announcement of increased spending that's going to take place in Europe. And this is really what drove this initial move higher. The secondary move higher obviously came after quote-unquote Liberation Day here in the U.S., which really accelerated those outflows. But I think it's important to remember that these outflows were already in motion before the announcements of Liberation Day. And so what that's telling us is that over the longer term, we may continue to see these flows actually continue. Because when we look at where we are on the euro, I can make an argument and say the euro has broken out, and we could be heading up. We already have cleared this one level of important resistance at 113. It looks like we've already now come back up to this 115 area. And really, if you can break the 115 region, you're talking about a euro that could be getting back into the 120s. And it's really the same thing when you start looking at the British pound. The British pound has also had a really big move, and if we can get above this 130 area, it's also suggesting we can really start seeing the British pound moving back. Because at the end of the day, these currencies are very depressed relative to the U.S. because of the differences in interest rate policies that have taken place here, with the U.S. remaining higher for longer and the ECB more aggressively cutting rates. It's just like the same thing with Japan. Japan has seen its yen weaken rather dramatically because of the divergences of monetary policy, but really what's been driving the reversal in the yen has been the fact that the BOJ has been on the path of raising rates more recently. And at least as of this point, the things that I have read suggest that they're likely to continue to do that. So these dynamics, I think, are already kind of set, and they're already in motion. Liberation Day certainly changed them a little bit. It may have accelerated them in some ways. And that's why I say I think we could, over the very short term, see some sort of snapbacks in them where we see the yen maybe weaken back up to a 146, where maybe we can see the S&P 500 rally all the way back to the Liberation Day high of 56.71 or so. But that doesn't necessarily mean that the longer term narrative has actually changed. And those are some of the things that we're going to really need to focus on a lot more once we get past, this week, I think, because as we go into earnings season, we're also going to be hearing from a lot of companies, and they're going to be telling us a lot about their earnings and the impacts that they're seeing and or not seeing, or what they're expecting in terms of their guidance going forward. And I think it's going to be hard for anybody really to give guidance in this type of environment where things are changing on the fly. But again, we'll have to wait and see how things develop over the next couple of days. Anyway, I hope you enjoyed this video. Please remember to subscribe to this channel, share it with your friends, and we'll see you again midweek. Bye.